One morning, people opened their banking app and saw $0 balances. Not low, not delayed, zero. For a few hours, the digital heartbeat of trust flatlined, and we were told, relax, just a glitch. Let me ask you something. When your dashboard flashes red, do you fix the engine or tape over the warning light? Because that's exactly how this system handles danger. Minimize, distract, move on. But systems don't fail in one dramatic moment. They fail like a body with systemic disease. Quiet inflammation, then sudden collapse. Tonight, we're not chasing headlines. We're doing a forensic autopsy. Because the $0 balance incident may not be the story. It may be the smoke signal for something bigger. A controlled demolition of confidence while pressure builds in places most people never watch. The debt markets, commercial real estate, weak banks, and a silver vault system that's been bleeding out. And if physical silver keeps draining while paper exposure stays crowded, that's not a normal market. That's a trap door for a short squeeze. Here's what we're about to map, step by step. Why a temporary glitch can trigger permanent behavior shifts. Why debt and interest costs are choking policy oxygen. Why commercial real estate stress is poison flowing through bank balance sheets. And why silver inventories may be the first domino nobody on TV wants to touch. By the end of this video, you'll have a simple framework. What to ignore, what to track, and where opportunity hides when fear gets weaponized. Because in this market, if you wait for official confirmation, you won't be early. You'll be exit liquidity. If this were one weird data point, I'd ignore it. But this isn't one light on the dashboard. This is 6 red lights flashing at once. First light. U.S. national debt is now $38.56 trillion. That is not a number. That is a structural burden. At this size, policy stops being strategic and starts becoming survival management. Every move becomes defensive. Every mistake becomes amplified. Second light. Interest on that debt is on track to cross $1 trillion this year, over $1 trillion just to service the past. When interest costs eat oxygen, the real economy starts gasping. That's how fiscal poison flows through the veins of everything else. Third light. Commercial real estate delinquencies at 7.47%. Office delinquencies at 11.76%. That's not a crack, that's rot in load-bearing beams. And where does that rot travel? Into lenders, into regional balance sheets, into confidence. Fourth light, the sleeper signal. COMEX silver stocks down 22%, a drawdown of roughly 117 million ounces since September 2025. When physical inventory drains while paper claims stay loud, risk compresses into one point. Translation, the exit door gets smaller while the crowd gets bigger. Fifth light, 57 FDIC problem banks flagged. Not all failing tomorrow. But strain is how failures begin, quietly. Banking stress doesn't ring a bell at the top. It whispers in the plumbing first. Sixth light. Crypto fear index hit 5 on February 6th, 2026. Extreme fear. You don't need to love crypto to read that signal. Risk appetite is a nervous system, and that nervous system is screaming. Now stack them together. Debt overload, interest suffocation, commercial real estate decay, vault drain, bank strain, sentiment panic. Any one of these could be noise. All 6 together? That's a coordinated stress signature. That's a system running hot, leaking pressure, and pretending everything is normal. And now comes the real question. How do these signals connect? Because once you see the chain, the glitch story falls apart. Now we connect the dots. Not conspiracy, not vibes, mechanics. Start at the top. $38.56 trillion in national debt, plus interest spending on track above $1 trillion. That combination creates a policy trap. Here's the trap. Keep rates higher and weak balance sheets crack faster. Cut too fast and inflation credibility gets torched. Spend more to patch everything and debt service gets even heavier later. So what happens? Authorities manage optics while pressure builds underneath. It looks calm on the surface while the foundation sweats. Next link. Commercial real estate delinquencies at 7.47%. Office at 11.76%. That's not just a property story. That's a lender story. CRE stress behaves like infection. It starts in cash flows, spreads into collateral values, then hits loan performance. And when loan performance deteriorates, confidence in the lender deteriorates with it. That's why the 57 problem banks signal matters. It doesn't mean collapse everywhere tomorrow. It means there are enough weak organs for systemic inflammation. Now insert the trigger event. People open an app and see $0 balances. In a healthy system, that's annoying. In a fragile system, that becomes behavioral contagion. Because confidence in banking is binary. You either trust instant access or you don't. Once doubt enters, people move first and ask questions later. So the key question isn't, was the glitch technical? The key question is, did it land in a system already primed for panic? That's how sparks become first dominoes. Then comes the liquidity scramble. When trust drops, institutions care less about return and more about survival. Collateral quality becomes obsession. Funding gets tighter. Risk desks get jumpier. In that world, paper promises get questioned harder, and physical settlement matters more. That's where silver re-enters the frame, not as a meme, but as a stress barometer. Now the pressure point. COMEX silver inventory is down 22%, about 117 million ounces since September 2025. If physical keeps draining while paper exposure stays crowded, structure becomes unstable, and unstable structures don't reprice politely. They reprice violently. If shorts are forced to cover into shrinking physical availability, price can turn from a quote into a weapon. This is the part most commentary avoids, because it sounds extreme until suddenly it's unforeseeable. Fair counterpoint. Maybe these are unrelated data points. Maybe debt, CRE stress, bank fragility, fear sentiment, and silver drain are coincidence. Possible? Yes. Probable? Less and less, when they cluster in the same window and point to the same direction. Tightening trust and tightening liquidity. So where are we now? The glitch was the headline. The chain reaction is the real story. Now let's map what happens next, and how not to become the victim when the next domino tips. Here's the difference between a victim and a survivor. One panics at headlines. The other watches the gauges. Let's build a simple 3 to 6 month framework. Scenario A, managed stress. No dramatic collapse, no Hollywood bank run. Just tighter credit, weaker growth, more unexpected write-downs, and louder reassurances. In this scenario, the system doesn't heal. It hibernates while disease remains active. People get complacent again right before the next shock. Scenario B, confidence shock. Not necessarily a giant collapse, just one more incident. Another technical issue, another institution under pressure, another liquidity rumor. Because people already felt the $0 balance moment, the next wave spreads faster. Confidence is like glass. Once cracked, it never returns to factory condition. The domino here isn't just finance, it's behavior. Consumers pull back. Depositors move money. Lenders tighten. Markets reprice the new reality. Scenario C, squeeze event. High impact, lower probability, but potentially non-linear. If silver vault drain continues and paper exposure stays crowded, markets can hit an air pocket where price gaps violently. That's how squeezes work. Not a gentle climb, a snap. Shorts don't cover because they want to. They cover because oxygen disappears. Now listen carefully. This is not financial advice. This is risk framework and preparedness. Rule 1, liquidity first. In stress cycles, markets punish people who have to sell. Liquidity gives you options. Options create opportunity. If you're strapped, every dip feels like disaster. If you're prepared, dips become menus. Rule 2, watch plumbing, not noise. Stop watching headlines like a soap opera. Track the hard dials. CRE delinquencies, especially office. Signals of bank stress. Funding strain, problem bank chatter, deposit pressure. Silver inventory trend and delivery pressures. Fear gauges, because sentiment turns before policy admits reality. The system lies with words. It confesses with data. Rule 3. Think in asymmetry. In squeeze-prone environments, upside can be nonlinear, but only if positioning happens before the crowd notices the exit shrinking. Don't chase green candles. Build a plan while fear is loud, spreads are wide, and people are frozen. That's where opportunity lives, right beside terror. Let's close where we started. The $0 balance event was not the disease, it was the fever. Here's the map in 4 lines. Debt this high creates structural fragility. Interest this heavy drains policy oxygen. CRE stress plus weak banks pressure confidence from below. Silver vault drain can become the ignition point if shorts crowd a shrinking exit. That's not panic, that's pattern recognition. For the next 30 days, don't guess, monitor. Track these 3 dials weekly. Silver inventory trend. Is physical still leaving? CRE delinquency trajectory, especially office exposure. Bank stress signals. Funding pressure, confidence events, problem bank risk. If all 3 worsen together, that isn't noise. That's controlled demolition risk accelerating. If you wait for mainstream confirmation, it'll already be priced. By the time anchors say unexpected, smart money is already gone. So if you want weekly forensic breakdowns before the narrative flips, subscribe, turn on alerts, and stay with this channel. We don't do comfort content, we do early warning. In a healthy system, truth arrives first and panic arrives last. In this system, panic arrives first, and truth shows up as a footnote. Stay sharp, I'll see you in the next briefing.